Hello everybody, David McCoy, Ochimo Properties, Real Estate Matters. We've been doing a series, we just started a new series on questions that real estate investors might ask. And there's all kinds of ways that people invest in real estate. One thing that people ask about is about foreclosures. I think we all know we had the real estate meltdown about 10 years ago, and the number of foreclosures went through the roof. We're on the other side of that now, but there still are foreclosures. And people sometimes, if they're trying to get property, they want to talk about, you know, how do you go about going through the foreclosures to buy some of those properties. The hope is that they can probably get a pretty good deal on those. So the way that works is that if a property is under foreclosure, then what happens is the people are given notice, and they're usually given a little time to try to fix it. But if they don't, then the property will be sold at auction. And that is going to normally be by the county. Usually each county everywhere in every state it handles their own foreclosures. It's usually done by the commissioners of the county who do it. They are often called commissioner sales. And so there will be differences depending upon where you are. Here in Jefferson County, it's probably changing now because the number of foreclosures is down, but generally from the time someone was notified that their property was going to be sold at auction, it took about a year and a half from that notice point before the auction actually occurred. In other counties, in smaller counties, it might be 60 days. So it can vary quite a bit. So the way that it is usually done, and the way it is done here, is that when a property, when the court decides that it's going to sell something at auction, then the court will send out some people that are supposed to do an appraisal of that property. That appraisal is not like a normal appraisal. Many times, in fact, probably most times, they do not get to go in and inspect the property. They do a drive-by and take some pictures and kind of try to get a general feel for the condition of the property, but it is not an exact appraisal, but it is good enough for the purposes of the court. Then the other thing that the court will do is they will schedule that for the foreclosure auction. And they will usually, like for our county, there's they post it online. And so they have a list of the dates, the foreclosure dates for the auctions, and you can go on and you can look at to see what all is scheduled to be sold on those days. Quite a bit can change from the time that they do that. So I would say, it's hard to say, 25%, maybe even as high as 50% on the actual foreclosure, the date of the foreclosure, they will end up not being foreclosed upon on that day, either because they have settled the debt or in some way, or they've gotten an extension or something along those lines. So when you get in there, you typically will have, you'll have a list, but a bunch of those will not actually go. So there's some rules, and you have to understand these rules. This is one of the things that most people do not understand. They think that they are going to go in and they are going to get a really great deal, and that that it will be just something real, real simple to do. And so, but that's in practice, that's not the way it works. Each state will have some laws. And they will vary a little bit state to state. But for instance, in Kentucky, if the property sells at auction for less than about 2/3 of what its appraised value was, and that appraisal, remember, we talked about that a minute ago. The court will send out people to do an appraisal. So that's the figure that they're basing it on. If the property sells for less than 2/3 of that amount, well, then the current owner can redeem that property within a year. So in other words, if you sell it and its appraised value is, for the sake of our argument here, let's say its appraised value is $100,000. And you get it for a steal, you get it for $50,000. Well, you are below that threshold. You're below that 2/3 value. And so because of that, the current owner, the person who lost the house, within a year, they can come back and they can pay you what you paid for it, and they can get title back from it. They can demand that it be returned to them. Most people don't understand that. It doesn't happen often, but it does happen where you can do that. And the other thing is that if you've made a bunch of improvements to that property, there is no guarantee that they'll be required to reimburse you for those improvements. So you could have spent a lot of money fixing this up in a year, and the previous owner can come in and take it over for what you paid for it at auction. So you got to know that. Most people don't know that. Because of that, at the property auctions, the starting bid, usually at the property auctions, the biggest players there are going to be the mortgage holders, which is usually the banks. So the banks have the mortgage hold, and the banks will end up in about 90% of the cases, the banks will be the one that actually buy those houses. There's various reasons for that, but in practice, that's what happens. So what they do, and so because of that, the banks know this. They know that if they pay less than that 2/3 value, that the previous owner can come back and reclaim it. So you don't have a really strong title on that property unless you pay more than that. So very, very often, the starting bid, the banks will generally do the starting bid, and the starting bid will be that 2/3 value plus $1 or plus $100. Just to make it clear so that when that property does sell, there is no danger of the previous owner coming back to redeem that property. So that's important to know. And the banks will buy 90% of these properties. Now, they don't keep them. Normally they have the reasons that they want to do that, and generally after they have bought them, they will then resell them. And that is what we call the REO market. If you've heard REO, it stands for real estate owned. And that is when the banks own this real estate and they want to sell it, they put it in their portfolio, and so that's how that goes about. And so then you would buy it directly from the bank, which is a whole nother process. And the bank isn't necessarily going to insist that they get as much as they paid for it. Those are complex criteria. It's hard to know exactly what it is. Each bank will have their own criteria about how they do that, but when the bank takes it over, they get credit for the amount that is owed to them, and so usually at the auction, they don't really have to give a check at all. They just put in the bid, and then they can assume the property. That's the other thing, is that at these auctions, you're required to bring a check. and the check depends upon, the amount of the check depends upon the value of the property. The court will require a different down payment amount depending upon how much that property went for. And it has to be a cashier's check. So you have to have that with you, and you have to turn that in if you have the winning bid. Then you have a certain period of time, I think it's about 30 days, to have complete financing figured out, and you have to close. You have to close, I think it is, I think you have to close within 30 days of that auction. So you have to be ready to do that. Now the other thing, so I've already told you 90% of these are going to be bought by the banks. So that leaves about 10% of these that will be sold to other parties at the auction. And you can really get spanked in those things, because there are, for instance, here in our town, there's a handful of people. It's not very many people. It's, 3 to 6 people or companies. And those guys come pretty much every auction, and they buy these things at auction. And so they are very experienced. They know exactly what these things are worth. And they are the ones who are buying the majority of this other 10%. And they, so when you're bidding against them, you're at a disadvantage. They know exactly what it's worth, and you don't. And they have even been known to kind of take advantage of that, just sort of for to entertain themselves. If they see someone who they think is inexperienced, and they might think it's fun to see how far they can run up the price before dropping out. So, so that's another thing. So if you decide that you want to go down to the foreclosure auctions, I would say these are the things you need to do. 1, you need to look it up online before you go down there. Know what's going to be on the docket for that auction. If possible, then, I would look for, when I have done it, I usually look for areas that I'm familiar with. So there'll be houses all over town, but I will try to choose spots I'm familiar with, mainly because I have a pretty good idea, or at least I can get pretty good information to figure out what that property could be worth when it was fixed up. And so you want to do that. You want to do your homework and get an idea of what that property's worth. You probably want to drive by it. Normally, you will not get an opportunity to go inside the property. In fact, I would say most of the time you can't wander around the property. Lots of times there is still somebody living there. Not always, but lots of times there is, and they don't want you around. As you can imagine, if they're about to have their home foreclosed on, it's not a good time for them, and they're having a hard time. And so you can't really blame them for not really wanting to be hospitable to people wanting to wander around their land. But you can drive by, and you can kind of get some rough idea about things. So then you need to make an assumption about how much work you think that property is going to need. You won't know exactly because you don't get to go inside, but you can make an assumption. And so you have to base all of that and kind of do the math and figure out, before you walk into the auction, your maximum bid. And otherwise you'll get spanked. You just will. Now, I'm going to tell you that it's, more than likely you will not get, one of these properties at auction. If you do get it at auction, you may do okay, but I would say there's probably a pretty good chance that you paid more than you needed to in order to get it. I'm not trying to discourage you, but I do think you need to understand these things. You don't want to get a situation where someone can redeem your property. You don't want to pay too much for the property to where you can't fix it up and make money on it, or if you want to move into it, you don't want to have spent more than that is worth. So you have to do your homework before you go down there, and you have to know how it works. If there is a property that you really like and the bank buys it back, you might write down who that bank is and contact them, and then negotiate with them after the fact. The people who are most successful at these foreclosures, however, probably get the properties before they go to auction. We mentioned here at the very beginning that lots of times a good number of those properties will not actually be sold at auction after all. And one of the reasons is that somebody bought it from them before it went to auction. So that's one thing that you might be able to do. So people are doing that. Lots of times people are trying to sell their properties ahead of time, and you can talk to their broker or whomever and see if you can work out a deal. Usually it's going to have to be approved by the bank, because more than likely, in order for it to work, the current owner is going to have to ask their lender to either write off some of it, or to allow them to sell it but let them pay off the rest of it over time, or they'll have to work something out. And that can take a while for you to get that approval. But a lot of these will be sold before they ever get to the auction, which is why they don't make it. You know, the way you can kind of do that is when the auction is when the property is being scheduled for foreclosure, once there's been a judgment saying that the property will be foreclosed upon, the court issues something called, it's a lease pendis, I think is the correct term. And that is just a notification from the court that there has been a foreclosure motion filed against your property. And the court will do that. So you will know that as soon as that's issued, that's you know, public record. And so you can search and look for those kinds of things, and then it gets into the dockets, which we've mentioned before. But that's how a lot of people do it, is they buy it before it ever goes to the auctions. And it's not necessarily an easy thing to do. I mean, you have to work through it, but that's how that's done. So you know, after that, I mean, the rest of it, you know, what you do with it after that point is, I mean, that, you know, that would be up to you, and that would be really a whole different set of videos. You might just fix it up well enough and keep it and rent it out, or you might fix it up and move into it, or you might fix it up and flip it to somebody. But you have to know how this works. You can really get spanked if you don't know how it works, and you could spend a lot of money and just get nothing for it if you don't know how the laws work. I think I ran a little bit longer than I wanted to here today, but there's obviously a lot of things to think about there. If you have any questions about that, please let me know. And if you found this video to be helpful, I hope you will click like. If you think someone would benefit from seeing this, please share it. And if you want to see some of these in the future, please click subscribe. And thanks so very much for watching, and I will see you guys next time. Have a great day. Take care, everybody.